You know the pitch. You open a bank account in the Caribbean and watch your portfolio grow tax-free while sitting on a beach. A whole cottage industry of internet gurus will tell you that setting up a foreign trust or an offshore corporation makes your tax obligations disappear. It's easy to see why this idea persists. Jurisdictions like Bermuda have a long, legitimate history as global financial hubs. But the Canada Revenue Agency operates on a strict worldwide income taxation model. If you live in Canada, you owe tax on every dollar you make, no matter where on the planet it sits. This chart shows the gap between fantasy and legal reality. Gurus promise you can open a trust, hide assets, and pay 0%. In reality, that playbook triggers worldwide taxation rules, mandatory T1135 reporting, and Section 94 deemed residency laws. Hiding your earned income in an offshore account is straightforward tax evasion. If you want to legally minimize your exposure, you have to operate entirely within a very narrow set of statutory exceptions. Let's say you ignore the warnings. You hire an overseas trustee and open an account in a tax haven, but you keep trading and managing the money from your condo in Toronto. The CRA does not care where your paperwork is filed. They care where the decisions are made. This chart shows how the government determines a trust's true residency. They look at the mind and management of the assets. If you are the one picking the stocks or directing investments from within Canadian borders, the structure is deemed a Canadian resident for tax purposes. This is a Supreme Court of Canada precedent established in the Fundy settlement case. You cannot bypass this test with a clever corporate structure. By setting up a DIY offshore trust while living in Canada, you end up paying full Canadian taxes anyway, plus thousands in offshore administrative fees, and you massively increase your chances of an audit. The government enforces this through what tax lawyers call the look-through rules, specifically the Foreign Accrual Property Income, or FAPI regime, and Section 94 of the Income Tax Act. These rules act as a trapdoor. If an offshore trust has a Canadian contributor, a Canadian settlor, or a Canadian beneficiary, the trust becomes tainted. Once the trust is tainted, any passive investment income sitting in that offshore account is taxed exactly as if you earned it at a local bank branch down the street. The CRA actively hunts for these setups. Through cross-border data sharing agreements like the Common Reporting Standard, they automatically receive information about foreign accounts. An offshore trust might offer you asset protection from civil lawsuits, but if you generated that wealth while living in Canada, you will not get a tax break on it. There is one specific scenario where an offshore structure legally minimizes Canadian tax. It's called a foreign grantor trust, often referred to as a granny trust. A wealthy non-resident grandparent transfers capital into an offshore trust, naming a Canadian resident beneficiary. The structure survives on one strict rule: a Canadian resident can never contribute a single cent. If you add your own money, the entire trust is tainted. When executed perfectly, this setup allows the investments inside the trust to grow without triggering Canadian capital gains tax until the money is officially distributed to the beneficiary. It is an effective tool for passing down multi-jurisdictional family wealth, but if you are a self-made professional trying to shield your own income from the CRA, this structure does nothing for you. Even without complex trusts, simply buying foreign stocks directly triggers an immediate compliance burden. The second your foreign property costs more than $100,000 Canadian, you must file Form T1135. Filing a detailed T1135 requires tracking the maximum cost and year-end cost of every single foreign asset and calculating your adjusted cost base across constant currency fluctuations. Filing late carries severe, compounding daily penalties. Retail investors looking for foreign market exposure can bypass this reporting trap entirely. Balancing foreign exposure against the administrative cost is key. Buying U.S. stocks directly puts you in the high exposure, high burden quadrant. Canadian-listed global ETFs give exact same exposure with near zero compliance burden because they are legally exempt from T1135 reporting. You give up direct voting rights and individual asset control. In exchange, you get global diversification without paying an accountant to untangle your cost base. If you are watching this and realizing you already set up a flawed offshore account or forgot to file your T1135, ignoring it is the worst possible move. You can use the CRA's Voluntary Disclosures Program. By coming clean and fixing the omission before they audit you, you avoid massive gross negligence penalties. This matrix outlines your correct approach. DIY retail investors should use Canadian-listed global ETFs for offshore exposure without the paperwork. To pay zero Canadian tax, pay your departure tax and sever residency. Receiving non-resident wealth? Use a granny trust to protect capital entering Canada. Offshore isn't a magic word that makes taxes disappear. It is a highly specific structural tool, and flawless compliance is the ultimate cost of admission.